In this video, we're going to look at another more advanced concept related to merger models and accretion dilution, which is looking at expense synergies. Now, in the previous video, we looked at revenue synergies, and we said that they correspond to situations where 1 plus 1 equals 3. So you have revenue for two companies, and you add them together, but in addition to just adding them together, you can actually sell more products or get a higher price for your products or something else like that, and as a result, you get extra revenue. So that's how you can think about revenue synergies. With expense synergies, it's the opposite. Expense synergies are cases where 1 plus 1 equals 1.5. So rather than equaling 2, it only equals 1.5. So we have two companies' expense profiles, we add up their expenses, and it comes out to less than what the companies operating separately would have had. So how can something like this happen? Well, if we go back to Apple's three statements right here, remember that under operating expenses, we had research and development and then selling, general, and administrative. And we did not go into the level of detail where we looked at individual employees within each of those categories, each of those departments. But if we had, go back to the merger model right here, let's say that in research and development and SG&A, Apple has 1,000 employees in R&D and then 2,000 in SG&A. I'm just completely making these numbers up. And then research and motion has, let's say, 200 employees in R&D and then 500 in SG&A. So if we were to just combine the operating expenses for both of these companies, then we would just assume that all these employees continue to exist as is in the combined company and everyone comes over and is paid exactly the same rate. But what often happens actually is that when two companies combine, oftentimes many of their employees are redundant. So for SG&A, this occurs actually quite a lot. And what happens is the G&A part, so administrative employees, so anyone who does accounting, customer support, organizational tasks, anything like that, oftentimes many of these functions are redundant when you combine two companies. So what actually happens is that when you have the combined company here, Apple and RIM, on the R&D side, you might actually just add together the 200 and 100 and all the employees would come over as is. But on the SG&A side, you would take these numbers and maybe you find out that you don't need 100 employees now. So you're redundant by around 100 employees and you can subtract them. So we have a case where we have added together these numbers, but we actually don't need as many employees and we can cut some people out and reduce our headcount. So that's the most common example of how expense synergies occur. You combine two companies and you find out that certain employees are redundant and that the tasks that they're doing can be handled by other people in the combined company. Now, another way that you could have expense synergies here, the first way that we just went over is reduction in headcount. But another way that you could have expense synergies is you could have a reduction in pay. So maybe RIM's employees are getting paid significantly more than Apple's or even just a little more. And under the new company, they all get paid Apple's standard rates, so the average expense per employee falls. The average headcount expense falls for the combined company. So those are two very common ways that expense synergies could come up in the context of a merger model like this. Again, we do not have the data for employees for Apple or RIM or the average expense per employee, so we cannot really make too much of a precise calculation here, but that's how we would actually go about doing that if we actually had that data. Some other common ways that expense synergies can occur, one would be reduced manufacturing costs. So maybe it costs RIM a certain amount to manufacture each BlackBerry, but then when they combine with Apple, they can combine some of their manufacturing facilities and they can lower the overall cost to produce it. And of course, that wouldn't increase their revenue, but it would decrease their cost of goods sold. So that's another way that you can have this happen. You can also have a situation where you have building consolidation. So maybe Apple and RIM both have buildings or factories in Seattle. And when they combine, they can actually consolidate their buildings and they can save on rental expense. They can save by not having to invest as much separately in the different buildings, and they can consolidate their operations like that. So saving on rental expense. So those are some common ways that you can come up with expense synergies in the context of a merger model like this. Now, once again, in this case, we do not have data that's nearly detailed enough to actually make this kind of calculation. So what we're going to do here instead is just go with a simple percentage assumption once again, and we're going to say 10% for cost synergies as a percentage of operating expenses here. Now, if we wanted to, we could also assume some kind of expense synergies on the cost of goods sold side. So we could go in and say that maybe they save 5% or 10% in terms of cost of goods sold. But usually when you have a situation like this with two technology companies combining, especially, most of the synergies are going to come on the operating expense side by eliminating employees or by paying employees differently. So to actually implement it in our merger model now, let's go down to our combined income statement. You'll see I have right under operating expenses this line for OpEx synergies. Remember from before that we had entered these new lines for revenue synergies and the COGS associated with revenue synergies. So for OpEx synergies, what I'm going to do here is go over to RIM's operating expenses. So around 2.7 billion going to 3.3 billion. And then I'm going to go up and multiply by this 10%. I'm going to anchor it with F4. So we have 270 in year one, going to 326 in year two. And again, this number is really representing employees that have been laid off who are no longer needed, or perhaps employees getting paid less, or perhaps buildings getting consolidated and the company saving on rental expense. Those are a couple examples of what this number might actually correspond to. Now, in terms of incorporating it into the model now, what we have to do is modify the operating income formula right here. So I'm going to press F2, and what we need to do here is make sure that E73 is being added to this calculation. We're adding it because in this calculation, we're actually subtracting operating expenses. Operating expense synergies are the opposite of operating expenses, so we want to be adding in that number so that our operating income here goes up. So I'm going to add E73 and then subtract E75, 76, and E77, the depreciation, amortization, stock-based comp. So we'll copy that formula over. And looking at our accretion dilution now, we see that it has gone up again by a bit. So it's 15% in year one and now 17% in year two. So if I just press Control Z here to move back, we see it's gone up by around 3% in year one and then around 2% in year two, which is reasonable considering the expense synergies at that level. Revenue synergies overall have more of an impact here because the revenue number is bigger to begin with. But that is how you would actually go about incorporating operating expense synergies into your model. Now, if we had COGS synergies, so if we could reduce our cost of goods sold somehow, then we would simply add that in here somewhere, and what we do is increase the gross profit, and we would add in the synergies from reducing our cost of goods sold right here. So those are a couple examples of how you would actually incorporate the concept of expense synergies into your merger model like this. When it comes to modifying a company's income statement, the revenue synergies and expense synergies are really the two main items that you have to be aware of in the context of a merger model. There are a couple other things that will come up later, but these are really the two hidden effects that you can get in a model like this when you combine two companies, and it diverges from what you would normally predict by simply combining their income statements. So with all this in place, we're now done with our treatment of synergies in merger models. And what we want to do next is go into the next topic, which is actually combining two companies' balance sheets. So we're going to look at RIM's balance sheet over here on the seller side, and then we're going to look at Apple's balance sheet over here on the buyer side, and we're going to combine these and look at some of the challenges that come up when we combine them, and look at some of the additional items that we need to create in our merger model to take into account the fact that when you combine two companies' balance sheets, it's not always straightforward, and that sometimes you run into issues that makes your balance sheet not actually balanced. So we'll look at how we deal with that and some of the additional items that get created when we combine two companies' balance sheets.